Welcome back to All About Economics. Have you ever really thought about where money comes from? Not the paper notes and coins, but the actual numbers that appear in your bank account. It can feel like money just materializes out of thin air, and you would not be entirely wrong. In this episode, we unravel one of the most surprising facts in all of economics, that most money is created not by the government's printing press, but by ordinary banks, simply by making loans. Then we will see how a crisis can make money vanish, how the central bank can play the hero, and how it pulls off its most elegant trick of all, doing something while appearing to do nothing. Let us start at square one. Section 1. The monetary base. The foundation of all money in an economy is what economists call the monetary base, or simply M0. Think of it as high-powered money, the raw material from which everything else is built. It has two parts: the physical currency held by the public, the notes and coins in wallets and tills, and the reserves that commercial banks keep at the central bank. The central bank controls this base directly. When it wants to expand the base, it does not usually print notes. It credits reserves into the banking system electronically by buying assets like government bonds. So the true act of money creation by the central bank is digital, not physical. M0 is small, but it is powerful, because it is the seed from which the much larger money supply grows. Section 2. Banks create money. Here is where the magic happens. When you deposit money in a bank, the bank does not lock it in a vault. Experience tells it that on any given day, only a small fraction of depositors withdraw cash. So it keeps a fraction in reserve and lends the rest out. That loan is spent and ends up deposited in another bank, which again keeps a fraction and lends the rest, and so on down the chain. Your original deposit still exists as a number you can spend, but a new loan and a new deposit have been created on top of it. The same base money now supports a growing tower of deposits. This is fractional reserve banking, and it is not a conspiracy or an accident. It is the designed architecture of every modern economy. Section 3. The money multiplier. The pattern follows a precise formula, the money multiplier, which equals 1 divided by the reserve ratio. If banks keep 10% in reserve, the multiplier is 10, so 1 unit of base money can ultimately support 10 units of deposits. The total money supply, which we call M1, is the monetary base multiplied by that multiplier. This single equation is the engine of the whole system. It tells us two things at once. First, the money the public actually uses is far larger than the base the central bank issues. Second, the central bank can influence the money supply either by changing the base or by changing the reserve ratio that sets the multiplier. Control the seed and the multiplier, and you steer the entire money supply. Section 4. M0 versus M1. So we have two key measures, and the difference matters. M0, the monetary base, is currency plus bank reserves, the high-powered money the central bank issues directly. M1 is the money the public actually spends, currency in circulation plus the balances in checking accounts. The gap between them is the work done by the banking system through lending and the multiplier. In a healthy economy, M1 is a large multiple of M0. The striking truth that follows is this: the overwhelming majority of the money in your economy is not cash at all. It exists only as deposits, as numbers in bank accounts, brought into being the moment a bank makes a loan. Section 5. When money vanishes. Now watch what happens when confidence breaks. Imagine a wave of uncertainty hits, and people across the country start to lose faith in their banks. They rush to withdraw their money, not to spend it, but simply to hold physical cash under the mattress. Economists call this a negative internal shock. The word internal is key because the problem started inside the money market itself, not from some outside event. And here is the crucial consequence. When cash leaves the banking system, banks have fewer reserves to lend, the multiplier works in reverse, and the total money supply actually shrinks. A simple act of caution by millions of people can quietly drain money out of the entire economy, choking off credit exactly when it is needed most. Section 6. The central bank is hero. So how do you fix a shrinking money supply? This is where the central bank steps in, and the fix is more elegant than you might expect. To counter the cash drain, the central bank simply expands the monetary base by the right amount, buying assets, and injecting fresh reserves into the banking system. This monetary expansion exactly offsets the money that the frightened public pulled out. The total money supply is restored, credit keeps flowing, and the panic need not turn into a depression. This is the central bank acting as the manager of the money supply, leaning against an internal shock. It is the modern answer to the bank failure spiral that deepened the Great Depression we studied in Episode 1. This is why a modern central bank is called the lender of last resort. When private confidence collapses and everyone scrambles for cash at once, the central bank stands ready to supply whatever liquidity the banking system needs, breaking the panic before it can feed on itself. It is a striking inversion of the usual fear about money creation. Here, creating money is not the disease but the cure, precisely calibrated to replace what frightened savers withdrew, no more and no less. Get that calibration right, and a terrifying internal shock becomes a problem with a surprisingly simple fix. Section 7. Doing something while doing nothing. Now the most surgical maneuver in the toolkit, sterilization. Picture the Bank of Israel wanting to weaken its currency, so it goes into the foreign exchange market and buys up US dollars, paying with newly created shekels. That purchase achieves the currency goal, but it has a side effect. It pumps fresh shekels into the economy, which would expand the money supply and risk inflation. So the central bank performs a second, offsetting move. It sells government bonds to the public, soaking up exactly the same amount of shekels it just released. The currency intervention stands, but its impact on the domestic money supply is canceled out. The bank has, in effect, done something in the currency market while doing nothing to the money supply. That is sterilization, a true financial balancing act. Section 8. The toolkit. Step back and you can see the central bank's full set of levers, all working through the machine we have built. Open market operations, buying or selling bonds, expand or contract the base day-to-day. The reserve requirement sets the size of the multiplier, and sterilization lets the bank act in one market, like foreign exchange, without disturbing another, the domestic money supply. Behind every one of these tools is the same simple architecture, a monetary base set by the central bank, multiplied by a banking system that creates money when it lends. Once you see that, the headlines about central banks stop sounding like magic and start making perfect sense. They are all moves on one board. Conclusion. We have opened the machine that makes money. The monetary base, M0, is the high-powered seed the central bank issues. Commercial banks multiply it into the far larger money supply, M1, through fractional reserve lending, governed by the multiplier of 1 over the reserve ratio. When a panic pulls cash out, the money supply shrinks, and the central bank can expand the base to offset it. And through sterilization, it can act in one market while neutralizing the effect in another. The headline to carry with you is simple but profound. Banks create money when they lend, and the central bank's job is to manage the whole system. Next, we turn to what that money is worth, with inflation and the Phillips curve. If this made money make sense, please subscribe to All About Economics and share it. See you there.